Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we are diving into a 10Q filing, so prepare yourselves for a financial adventure. But be warned, this one might make you question where your money is going. This report is like a checkup for a company, telling us how they've been doing over the last 3 months. We're about to break down the good, the bad, and the potentially ugly for Nexscient, a company trying to make waves in industrial equipment monitoring. Also, before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description. Monitoring, as to before, is like a checkup for a company, telling us how they've been doing over the last 3 months. We're about to break down the good, the bad, and the potentially ugly for Nexscient, a company trying to make waves in industrial equipment monitoring. For start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. First off, this is a Form 10Q, which is basically a quarterly report that public companies have to file with the Securities and Exchange Commission, the SEC. Think of it as a school report card, but for businesses. This particular one is for the quarter ended March 31, 2025. Nexscient Inc. is the company in question. They're based in Los Angeles, and they're in the business of, at least trying to be in the business of, condition monitoring. What is condition monitoring, you may ask? Well, they're trying to keep an eye on the health of machines in factories and other industrial places. Here's a red flag. When asked if they filed all required reports in the past year, they said, no, that's not great. It means they might be behind on their paperwork. The company calls itself a non-accelerated filler and a smaller reporting company. What does that mean? These terms are used by the SEC to classify companies based on their size and how quickly they have to report things. In short, it means they are small and therefore might not have many procedures in place. As of May 15, 2025, they had about 21.2 million shares of stock out there. This number is important for calculating things like earnings per share, which tells you how much profit each share of stock gets. Now, there's a warning about forward-looking statements. This is a standard disclaimer, but it's important. Basically, they're saying that anything they predict about the future might not actually happen, so don't hold them to it. Now, let's get to the interesting part, the financials. We're going to focus on the balance sheet here, which is a snapshot of what a company owns, which is the assets, and what it owes, the liabilities. Let's check the balance sheet of March 31, 25. First, cash. They only have about $21,000 in cash. That's not a lot for a company trying to grow. If you look at June 30, 2024, they had around $76,000. That means they burned through a lot of their cash reserves fast. Total assets are about $181,000. That includes everything they own. Now let's look at the other side of the balance sheet, the liabilities. Total liabilities are about $397,000. This is more than their assets. This means Nexscient owes more than it owns, which is a big problem. A key part of it is something called convertible debentures, basically loans of $330,000. Last year, in June, these liabilities did not exist. Now let's go all the way to stockholders' equity. This section shows the owner's stake in the company, but here it's not equity. It's actually called a deficit because it's negative $216,000. This confirms our suspicion because it shows how much the liabilities outweigh the assets. If we go back to June 30, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2020, 2024, they had 81,000. So they completely lost that. As a reminder for the balance sheet, there's this fundamental equation, assets. If we go back to June 30, 2024, they had 81,000. So they completely lost that. As a reminder for the balance sheet. There's this fundamental equation, assets. If we go back to June 30, 2024, they had 81,000. So they completely lost that. Wetty is negative. It's a bad sign. Now let's go to the statement of operations, which shows how profitable the company is. Revenue is at 0 for both this year and the previous year, so it is still very early for them. Total operating expenses for the 3 months ended March 31 to 2025 were about $115,000. That's how much it cost them to run the business. At net loss, they lost $135,000 this quarter. The statements of cash flow tells you how the company made and spent cash. Net cash used in operating activities. This means they are burning cash at $367,000. Net decrease in cash of $54,000. Okay, now they're going to get into some serious stuff. They say there's substantial doubt about whether they can continue as a going concern. That's business speak for we might not be around much longer. They have generated no revenue since they started and they're losing money. They need to find a way to make money or get more funding, or they might not survive. They issued convertible debentures. These are essentially loans at 9% interest. The debentures can be converted into stock at a later date. The company is authorized to issue millions of shares of stock. In January 2025, they issued 16,000 shares to someone on their advisory board. Then in February, they issued 350,000 shares as part of buying a software platform. Also in March, they issued 50,000 shares to a consultant as compensation. They also have lease commitments for their office space. They have a related party transaction, which is an agreement with their CEO. The CEO gave them a loan, and in return, they gave him shares of stock. After the quarter ended in April 2025, they issued more convertible debentures and more shares to advisors and consultants. So they're still trying to raise money. Now, the management gets a chance to discuss what happened this quarter. They acknowledge they are in the development stage and haven't made any money yet. And they say their available capital isn't enough to last more than 3 months without an infusion of cash. They admit that their disclosure controls and procedures were not effective. Basically, they are saying that they can't guarantee the information they're putting out is totally accurate. They blame the lack of staff and segregation of duties. They also don't have an audit committee yet. Finally, the report is signed by the president and CFO, certifying that the information is accurate to the best of their knowledge. Now, what do I think of this? Nexscient is in a tough spot. They're trying to break into a competitive market with very little cash and no revenue. They're burning through money quickly and they need to raise more funding to survive. The biggest risk is that they run out of money before they can get their product off the ground. They need to show investors that they have a viable business plan and that they can generate revenue. Right now, it's hard to see how they can turn things around without a major change. Alright, that's our breakdown of Nexscient's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.